The Dow had a very rough patch yesterday. It fell around 800 points. It wasn't just the Dow, it was also the S&P and Nasdaq that suffered, and that's one thing we don't typically see. The Nasdaq seems quite untouchable over the last couple months, barring perhaps the last few trading sessions where Apple and Tesla have been having some issues. Now, yesterday Apple cracked badly, and that's perhaps what also, to a certain degree, added to the fall that we saw. But, it wasn't just Apple. It was Facebook, Amazon, Netflix, Alphabet, Microsoft. They all closed lower. So that's how, those are the key movers from the US market. Obviously, traders are also bracing right now for the US jobs report that should be out soon, and that should again have some kind of weighing in on how those markets perform. Let's get on board someone who'll be able to decode this for us a lot better and someone who's a lot more knowledgeable. We have Seth Freeman, who's a Senior Managing Director at Glass Ratner Advisory and Capital Group. Good morning, Seth. Great to have you with us. Amidst all the chaos that's happening in the world right now, and particularly in California, we were just chatting about the fire that's happening there. I hope everyone close to you and your family and friends are safe. But it's also, one might say that, last night we also saw the equity markets get put on fire literally a little bit. So what are your thoughts there, and what really are we seeing? Is this profit booking, or is this some kind of sharp reversal that's going to continue to play out?
Well, I hope it's not a very deep reversal. Certainly, the tech stocks have been, just booming the last few weeks, and the market has, in general, has gone up nearly 60% from the March lows. And maybe the market got ahead of itself a little bit. I think the fact that it's also, the first few days of September. And some traders are back, for the emphasis on growth is a little touchy. We're also seeing, significant problems in the oil industry here in the United States because of low oil prices. Refineries have had a huge glut. There's been a lot of Chapter 11s in the oil business in the last 3 months. And in terms of the S&P 500, the tech stocks, Facebook, Google, Tesla, and so forth, they've risen so fast that even as part of the index, their share in nominal terms is higher. And so a fall off in the NASDAQ also impacts the S&P.
Well, that's really interesting, Seth. We didn't really know that there was such a direct correlation between those two indexes. But, so let's talk about how bad this could potentially get. Given that we have ample liquidity in the system and the Fed is going to continue monetary support and stimulus, do you think that these dips will continue to be bought into? Given that, there is just that extra liquidity floating around, or do you think at some point now investors start taking a judgment call, perhaps that the disconnect between the economy and markets needs to be bridged? Because so far it hasn't. Economy has been in trouble, GDP is contracting, but markets are flying. So why should they now have to suddenly correlate with each other?
Well, in theory, markets are forward-looking. So there have obviously been very high expectations of growth and some form of a snapback. It's very interesting. There's a stock trading platform called Robinhood, which is being cited as a source of a high level of consumer trading that has supposedly helped support the market over the last 3 or 4 months. Partly the excuse or the explanation is partly that people are at home, sheltering in place, saying, okay, I'm going to trade the stock market. So maybe that's part of it, with elementary schools coming back in now that it's the fall. But I think in all seriousness, there's just concern about the growth that we're going to see. And maybe there's some concerns as well about both the Fed exposure as well as, our election is basically 2 months away. and people wondering what might happen then.